Welcome to another week of the Educated Homebuyer Live. Happy Juneteenth, Josh. We are here to answer mortgage and real estate related questions as we do every single week. Update you on the economy, update you on interest rates, and have a little bit of fun. So, Josh, how was your Juneteenth today? Only positive things. We're not looking for any negativity. Only positive things that happened.
Listen, I am behind and support the idea of celebrating Juneteenth. I despise any holiday that doesn't land on a Monday or a Friday. If it's a bank holiday and wires are not going, so then settlement agents at escrow and title and attorneys' offices decide to not work. And then lenders go, well, we let our staff off too. So we're not going to be.
It kind of breaks the week up, it's like a party in the middle of the week.
But it doesn't. It means I sat here unproductive today.
Well, that's on you, my friend. So it is Juneteenth. Show might be light. We might have a lot of people here. I don't know. We're going to find out tonight. But as we always do, we're going to go over some charts. We're going to look at what's happening with regards to inventory, what's happening with regard to interest rates, and more importantly, going to get to your questions. So start putting them in the chat now. And as we're done, we'll start answering them. I do want to correct a mistake. Last week, I mentioned that our forecast for the second half of 2024 would be out this past Tuesday. For those of you that follow the podcast, you're aware it wasn't there. That's because we had some delays, and it'll actually be out next Tuesday. So this past week, we talked about inventory and why inventory is not created equal and what you should pay attention to. And more importantly, next Tuesday, we'll be talking about a forecast for the second half of the year. So for those of you who follow the podcast, be sure to check it out. But now, Josh, we're going to do as we always do, and we're going to dive into some charts. I don't know if this will work for me. No, you're going to have to hit it on your side. This fancy board, you're going to have to hit it over there.
Oh, boy.
There we go.
Now we just got to move it in place. This is hard. It's on the stage. Why is it there?
There we go. There we go. All right. So inventory nationwide now sitting at 621,000 single-family homes that are currently unsold. That's up 1.5% for the week and 38% more than the same time last year. Looks like inventory growth over the last year has plateaued. 2 weeks ago, inventory was almost 40% more than 2023. That ends 31 weeks of inventory growth expansion. But again, it's all relative, right? You don't care unless it affects your market. And that's what we're going to talk about here in Orange County. I know there's a lot of people that follow us here in Orange County, so we're going to take a look at these numbers. Orange County sitting at 2,956 homes. This is the highest level of inventory that we've seen going back into 2022. So no point in 2023 did we hit this level. Still well below 2019 levels, but something to pay attention to. Huntington Beach sitting at 179 rather. We haven't been at 179 since December of 2023. So what, 6 months ago, Josh, 6.5 months ago is when we last saw numbers around 179. This is the chart. So this is from Calculated Risk. This is his fourth look at the May numbers. Again, active inventory. So these are properties that are unsold in the markets that he covers. You can see year over year, essentially every market is more or less up outside of Maryland as a state as a whole. Again, last week I mentioned some are states, some are cities. So depending on where you're located, just pay attention. But more importantly, just compare it back to 2019, a little bit more normal market at that point. And, you have something to base it off of. So again, the outlier that continues to be the outlier is Jacksonville. 106%, 107% year over year, and 42% versus 2019. New listings unsold. So new listings, 71,000 new listings unsold this week, plus another 16,000 that were immediate sales. 87,000 total sellers this week. That's 1% fewer than last week and 9% more sellers than last year at the same time. And then again, we look at those new listing numbers, same thing. Not going to keep it up here on the screen. You can go back and check it out. But again, most markets compared to 2019 still have quite a bit less inventory or quite a bit less new listings than going back that same time.
I meant to pull it out, Jeb, but Lance had a really cool chart this week that basically showed that 65% of the markets that have reached back to the 2019 levels are in Florida or Texas. It was a cool chart, and I forgot to snip it. My apologies.
Yeah, it's important, and we should pay attention to that, right? Because we just talked about it in that episode that we did on the Educated Homebuyer podcast, talking about inventory, and we talked about how Florida, Texas, Louisiana are the biggest markets where inventory has grown. And when we talk about nationwide inventory, nobody cares what's happening nationwide. Typically speaking, you should care what's more or less what's happening in your market versus what's happening on a nationwide basis. And if you're in that southern belt right there, something to pay attention to.
Absolutely.
Yeah, and this goes over the weekly changes. Again, we went from 611, 596 to 620, just 8,000 or so homes added to the market. Same week last year, we went from 443 to 451. The low was 240 back in 2022, and the high is currently where we sit at right now, at least since we started recording. I mean, since we started measuring over the last couple of years. So 620 is not the all-time high. It's just the peak for 2024. New contracts pending. So new contracts pending, 396,000 single-family homes in contract right now. That's up less than 1% from last week and just 2% more than last year at the same time. Just going to try to flip through these quickly. Did we miss that one? Oh, I put the same chart in there twice. I would have talked about home prices. Anyway, the chart, I put the wrong chart in here. Median price of single-family homes on the market is $455,400. That's basically unchanged from last week and more or less unchanged from last year. Home prices are 1% below the June 2022 peak when we look at nationwide. And then percent of properties with price reductions currently sitting at 36.4% of the market at the moment. So Josh,
Jeb, I'm just really off my game with charts this week because Housing Wire had another cool chart that looks like all of your other charts, but it shows the difference in the spreads between the 10-year and mortgages over the last 3 years. So we can kind of see how they've adjusted. We look at it a number of ways.
I saw that chart and didn't think to add it in either. So
yeah, it was cool the way it presented it, just so you can see how it's moved around over the last 3 years. I'd like if they could give us 5 or 6 years so you can see how damn low it was during COVID. But anyways, we digress. We haven't got a lot of data this week. Monday was boring. Tuesday, we got retail sales and 20-year bond auction. The 20-year bond auction was middle of the road, not bad, not good. Retail sales was weaker. So we got downward revisions. We've got downward revisions for the last 2 months. A fairly weak 0.1. Was it expected to be 0.2, Jeb? I think it was 0.2 or 0.3. So they were expecting a decent number. And this takes us back, Jeb, to this conundrum of everyone saying, are we going to have a soft landing or are we going to have a recession? What's going on? Why is the economy so resilient? Why have the Fed hikes not had the intended impact, or at least at the pace that was expected? A couple things here that I came across in a few of my reports today that I think explain this. This is household debt as a percentage of GDP. So you saw it got really, really high prior to the great financial crisis. Households were massively over leveraged. And as you can see, it's come way down at the beginning of COVID. We had a spike up and then continues this downward trend. So a deleveraging, less problem for U.S. households in aggregate, as a group. So it certainly doesn't tell us about any individual household. There's individual households out there who have way too much debt, regardless of what U.S. GDP is. So this is another way of kind of looking at it. This is household net worth relative to GDP, and it shows that household net worth keeps increasing. Now, again, this is not evenly distributed. I forget what the number is, Jeb, but isn't it something like the top 12 billionaires in the United States have more than the bottom 50%, like more wealth than the bottom 50% entirely? So this isn't to say, hey, wine and roses, everything's happy, guys. But for those who have good jobs, who have, are saving, earning, things are getting better. We are getting this situation of haves and have-nots. So the important thing is here to make sure you're getting your share, that you're getting assets and you're not just spending your money for things. We heard, Jeb, through COVID, we're talking about the experience economy. Millennials and Gen Z, they don't care about things. I get it. Experiences are important. Spending time with friends, family, all that stuff and building experience is important. But we also need to have assets, because the people who've done really well through COVID, through the pandemic, are those who owned assets. And that's why you guys are here. You want to hear about owning the asset of a home. This also, I wanted to throw this one here to put into context. Jeb, we keep hearing about the consumer's going to buckle. They're in so much trouble. And we hear delinquencies on credit cards, they're shooting up. That is correct, but they're shooting up from a very, very, very low baseline. So if you look at this, this is going back to 2002. So they had dipped going into the great financial crisis, spiked, and then have come down. And really, 1% to 2% delinquency rate is kind of normal. Where we would look at this and start going, something here that could be telling us is if we get above that green line at the 2 and move higher. So just again, to give some context, things are weakening. We can show you week after week data that things are weakening, but we can show you things here that there's a fairly strong base, at least in the U.S. consumer relative to the U.S. government. Jeb, Bill McBride over at Calculated Risk, we need to reach out to him. I need to reach out to him. He's been very busy. He said he definitely wants to come on and do an episode with us, but he did a very good look this week comparing the current market to that 1979 to 1982 timeframe. Everyone wants to go back and look at the great financial crisis and the housing crash and go, oh, see, the same stuff. It's coming again. There are parallels, but he kind of goes through and dissects and says, here's where we don't have parallels. Well, if you look through here in that time frame of 2000 to 2012 or so, demographics were working against us. We talk about demographics a lot. If you go back here in 1980, demographics were working in favor of the housing market. We had people in that prime, the bluish purple line there, 30 to 39-year-old age group. That is the driver for housing. And that's when people are buying their first home. First-time buyers are sort of the driver of the whole housing market. So you see that was in a big run-up. So it wasn't all that unexpected that we would have this dip here right around the time of the great financial crisis. And you throw really bad lending on top of that, and you see where we're at. Now, where we are now, we're not going to have a dip anytime in the foreseeable future of prime age buying people. Now, they may have the constraints of affordability where they can't afford to buy, but nothing is ever going to change 30 to 39-year-olds wanting to buy their first home. That's why we have sort of a buffer and a floor underneath the market. Wanted to show this. So he's just showing, again, going back to 1976, what this looks like when you have a slowing in a market is slightly negative, down to zero. And that's kind of what we saw and then recovered off of that. And that's not to say that we're immune to another downturn, but that big yellow box there, that's not normal. It is not normal. It takes demographics being against us, terrible lending standards, all sorts of things coming together to conspire. So if you're still of the opinion that that's going to happen, I'm sorry, it is not. We can have a dip. We can go below that 0% line, but we're not going down to 10, 15% year over year. So Bill wrapped it up here and says, we can be pretty certain we will not see a sharp decline in national prices since there will be few distressed sales this cycle, nor will we see a sharp increase in prices with strained affordability. My expectation is prices will follow a similar path to that 1980 period. So that, if you want to look back at history, that's the part of history you want to look at. Jeb, this was just an interesting tidbit that we're talking about housing here. Housing, we have homeless. We're spending large amounts of government money trying to solve this problem. This goes back showing in the 60s, they basically defunded institutionalizing mentally unhealthy people. And at the same time, we started then putting more of them into prison. So we house them, whether we like it or not, or they're on the streets causing problems. With that, just kind of getting to the chart here of bonds, we are firmly riding this green trend line down. You can see we've been at the bottom of it. We haven't even really made a run up to the top of the trend line. When you see those other two pivots that we have in there at, what is it, like 432 and 438, those should provide pretty solid support to keep us moving down that trend there. And when you look at it, we've got the next big resistance would be at 407. And then if we clear that, 385. So we've got almost an eighth to a quarter of improvement could come if we make the run down to that 4.7, and then another 0.25% to get down to that 3.85. And in terms of what does that mean today, 30-year fixed Mortgage News Daily has it at 7.02, FHA at 6.47. I threw Optimal Blue in here because of the holiday. Their day delay actually catches them up here. They're reporting a slightly lower interest rate on conforming, slightly higher interest rate on FHA. But the other box there in the middle, Jeb, I thought this was interesting. Mortgage News Daily reports the 1 week, 1 month, and 1 year change. We're basically sitting exactly where we were a week ago, exactly where we were a month ago, and exactly where we were a year ago. So we get together every week. We tell you guys what happened. You could just come back next year, and apparently everything will all be the same.
Exactly, guys. Exactly. All right. So let's see what we're going to do here. Having some issues on this side. All right, here we go. Okay, so somebody last week, you showed that chart, Josh, of the 10-year, and you showed it. That's a daily chart. My weekly chart, I should have put it in there, basically shows us breaking the trend on the weekly. We broke out last week out of the bottom of that trend line. We're out of that weekly trend. This week, we're confirming again that we're out of that and going lower. So the weekly essentially supersedes the daily chart, if you want to look at it that way. So at the moment, it looks like the trend has been broken. Does that mean rates are going to automatically shoot down? No. But it does mean that the high is probably in, at least, unless something absolutely crazy comes out that is more or less unexpected from anyone at this point, because the data is showing employment easing, it is showing inflation easing, and therefore likely to show a Fed cut probably. One of the charts that we saw today, Josh, I didn't know if you were going to throw it in there. There's a 59% chance now. September's in the cards for a cut. Is it going to happen? Hard to say. We'll continue to update you, as we know more, as more data comes in, and as those progress. So let's do as we always do, Josh. Actually, let's do this. Everybody likes to be pumped up a little bit, Josh. So we're going to, put a little pump in our, a little pep in our step this evening. So we have a lot of people in here, basically just telling you to do the deed, right? Hit the thumbs up. Not that deed, Josh. You're going the wrong. It's a holiday. It's not time for that. But to do the deed, smash the thumbs up. Subscribe to the channel if you haven't done so already. We've got several people in here that are normal. We don't know that they're normal. They're regular viewers. They show up every single week and post comments in here. And I saw a bunch of them earlier. Now I can't find them, but I posted a few of them. But nevertheless, if you're here, you find any value, hit the thumbs up. It does help the channel and helps us push out to more people. So let's move on. All right, Josh, got a couple of questions here. Let's start. I've asked a question. No, it says, will new fast food places increase the value of my home? A bunch popping up in my area. Fast food, I don't know. Hard to say, right? If you're in an area that has no fast food at all, and now it's the place to be and whatever else, maybe you don't want it right beside your house, but within a short drive, short walk. I don't necessarily say fast food is the right key, but what I picture is 17th Street in Costa Mesa, right? A lot of shopping, a lot of dining, a lot of opportunities for people to walk from their homes, ride their bikes, and go to cool restaurants and kind of just be in a little Belmont Shores area of Long Beach, that sort of thing. Like that, I don't know that it adds value, but it definitely increases people wanting that sort of thing. And, depending on what supply is doing, if you got enough demand, obviously that could drive prices up. But I think any sort of modernizing, renovating, adding some value, add things to the city are positive, but hard to say without actually knowing your area.
What about if it's liquor stores and gun stores? Is that a good sign for your neighborhood?
I will say there's a liquor store, I don't know, half a mile from my house, and I probably go there 3 days a week, 4 days a week, not for liquor, but for just the occasional, hey, you need milk, you drop in there. Hey, you need this, you drop in there. There's also a donut shop next door that I buy the kids donuts. So when I say the liquor store, it's kind of next door, but also a little Mexican restaurant in the same shopping center. So all of that stuff I like it because it's easy access. So, but did I buy the house because of that? No, it's just one of those things that you find out once you move in, like, hey, this is really convenient. Josh, we got Hilson saying, could interest rates come down below 4% again? So prior to the pandemic, Josh, we were flirting with 4% or lower interest rates, right? Prior to
you and I
the
just had this
craziness.
conversation 2
Yep.
days ago.
Yep. So, what are your thoughts on that? Could it happen again?
Absolutely. I'm way off my game with what we're doing here. But here, I do want to share this real quick because I had this one in here and I don't know what happened. And this kind of comes back to it. We got to go here.
Okay.
No, that's not it. This one. How do we take us out of the way, Jeb? Or we make us little? What do we do? Here we go. Okay. All I wanted to show on this. So this shows inflation year over year, going back to 1959. That downtrend. So in the early 80s, in the mid 70s, early 80s, we broke out of that. But we had 40 years unbroken downtrend. And we had this big break out of it. But just like we came back in after the 70s, you guys haven't had my Lacey Hunt reference in at least 2 months. So basically, he's saying the things that led to all this 40 years of decreasing inflation are still in play. And if that is true, then we are here and we're running back down to the levels of inflation that we've been seeing for all of those years. So if that is the case, which I do believe is true, what Jeb was saying is 100% accurate. 2018 rates had got up almost all the way to 5%. 2019 was an improving year where rates were dropping again. And by the end of the year, we were in the very low fours. And before COVID was even a thing, it looked like we were heading towards a slowing economy, if not recession, and rates would be in the high threes. So everyone wants to say, oh, we're never going to see COVID era rates again because it was QE 3 or 4 or 5, whatever the hell it was, the government buying treasuries and mortgage bonds pushed rates that low. And that's 100% correct. That's what got them to that level. But before we got to that level of QE, the bond market was already moving mortgage rates under 4%. So is it possible? Absolutely. Where is the low without government intervention QE? Probably somewhere in that 3.5% to 4% range. So that would be a low end. It's certainly not a prediction, but it is absolutely a possibility without government bond buying.
All right, good stuff. Dina makes a comment. So Josh, prior to coming on, said, I wonder if anyone will notice basically the fact that he's got a clean shaven face. Dina noticed, and she mentioned it. So, and making a mention that maybe it's a hint to me. I don't need a hint, Dina. I'm fully aware that I have a full beard on my face that every day gets contemplated whether or not it gets kept or not. And for the time being, it's winning the war. But we don't know how long. We don't know how long.
I generally keep it nice and consistent. Jeb shaves it off and then grows it Grizzly Adams, and then shaves it off and grows it Grizzly Adams. It's always in a state of flux with me.
I mean, part of me just wants to see how long I can actually go. And maybe I don't go until we get interest rates below 2%.
I say do it.
Just ever. No. Anyway, let's move on. We got a couple people talking. Well, this is a good question. This isn't the one I meant to click on, but let's do it. It says, what should I be wary of with lenders that don't charge PMI when you're putting less than 20% down? In the case here, he's talking about Navy Fed. Is there a catch? Pre-sending a question since I won't be able to watch live. So Quinn isn't here, but Josh, we always talk about this. There's no such thing as free PMI, right? Yep. You're essentially paying it's some form or another, whether you're paying it monthly or you're paying it by paying a higher interest rate, unless I'm wrong.
So if the lender is going to sell it into the secondary market and it's going to go to Fannie Freddie guidelines, the guidelines dictate what type of mortgage insurance coverage there has to be there. So the lender can buy it themselves, and it's transparent to you. They can include it in the rate, but it is there. So we're talking specifically about Navy Fed. They're a credit union. They can do anything they want. They're a portfolio lender. We have people ask sometimes about doctors loan programs. Some of the big banks do these doctors loans programs. You can do 5%, 10% down, 2 million, no mortgage insurance. Also a portfolio loan. They're holding it. They can do whatever the heck they want for whatever business purpose they see fit. So when you're looking at this and analyzing, is this a good deal? Is this the right deal for me? In this situation, you want to get a quote of a normal loan with mortgage insurance, compare them side by side. I looked up the terms on Navy Fed's deal right today. They make it a little difficult to see. They quote a rate, but they make it a little bit difficult to see if it's actually available. But what they were quoting today looked like it would be better than a loan at a slightly lower interest rate with mortgage insurance. So better in what sense? Better in terms of a lower monthly payment right now on the way in. But the positive, let's say if instead of 7% with no MI, you end up with an interest rate of 6.75 with MI. That MI could be anywhere, depending on your qualifications and how many borrowers and credit score and all that fun stuff. It could be anywhere from 0.12% to 0.95%. But say it's 0.5, you're going to have a higher monthly payment, but you could get rid of that mortgage insurance at some point. After a 40-year bull run in interest rates, we're all inclined to think, don't even worry about that because I'm going to go refinance and get rid of my mortgage insurance later. People right now are seeing, hey, I may not be able to refinance, but as values go up, I could get rid of my mortgage insurance. So multiple things there to consider.
All right, good stuff. 2 questions on New Jersey. Mina is asking, do you think there will be a large correction in New Jersey? Still seeing bidding wars and crappy houses going over asking. And then, Josh, we have another question here. It was from David. David says, what are your thoughts on the dynamics of housing in New Jersey? 3 areas in the top 10 largest increase since 2022. So as you guys are fully aware, we're located here in Southern California. Not really familiar with the New Jersey market in a way that I can give you any detailed information. But what I can tell you is the Northeast. Now, New Jersey, you may say, well, that's not the Northeast. It's close enough. And so New Jersey, New York, New Hampshire, Vermont, Maine, all of these areas, Maryland, like kind of going up the East Coast there, are having inventory issues, just a lack of supply. There's a lot of demand out there. What's causing the increase in demand? Hard to say, but there's definitely an increase in demand. And because of that, prices are going up. You're seeing competitive things. You're seeing what a lot of markets saw back in 21. It's now happening there again. So my thoughts on it are, as long as supply stays limited or stays at least in line with demand, you're not likely to see any big decreases in price. At some point, or if at some point rather, demand diminishes and inventory stays where it is or increases, right? So now there's more supply than there is demand. That's when you could start seeing fluctuations on price. But at the moment, doesn't look like that's in the cards just because of that supply and demand imbalance. But we'll look at it. You know, we showed some of those charts at the beginning showing you active inventory, new inventory there. Pay attention to that. You know, we'll show those every single week and you can kind of get a grasp on what's happening there. That's the best we can do for now. Josh, question here from a realtor says, are any of you worried that a war fixes inflation and recession? So typically a war doesn't fix inflation, Josh, because there's a lot of government spending during that time. I guess if there's a large enough war, nobody spends money but the government. And at some point, I guess that could bring inflation down. But what are your thoughts on the question as it's written? Worried that a war fixes inflation and a recession?
I'm pretty much in the same spot with you. I don't think it fixes inflation, and is what fixes inflation and recession. We haven't had a recession. We haven't had one for a long time. I don't count what happened at the beginning of COVID. That was weird, pandemic related, and disappeared in about 6 weeks. So if you say we haven't had a recession in going on 16 years, whenever you say the end of the Great Recession, we're due. We are due for a period of below trend growth. I've got a book at home I need to go back and reread and refresh myself. It's called The End of American Growth. Basically, for 200 years, when you're a young country, especially when you have industrialization and all of those things coming into play, massive levels of growth. So prior to like the 70s, they would scoff at 2% GDP, and we're struggling the last 10 years to get 2% GDP. As long as we have that, you know, I don't think we're going to have inflation over the long run. We had another comment here. Big G had just said, you know, it was caused by government handing out too much money. That was an element of it, but it was also people being locked at home and saving their money because they couldn't go out and spend. Then supply chain issues. We're going to look back in 10 years and this is going to be an aberration. That chart that we just shared with you guys, I'm not saying I know everything. I'm looking at that chart and I'm going, that's 60 years. It's a 60-year trend from basically the end of massive growth. And this isn't a uniquely American thing. It happens in all countries as they age and grow. It is going to be very, very hard to have a high level of growth. That doesn't necessarily mean a recession is coming. You can just have this little muddle along low growth market. But in terms of a war fixing anything, I don't believe so. I'm not a conspiracy theorist. I know, Jeb, you don't like it either, but people say, oh, well, government gets in trouble, they'll just go start a war. We've got lots of little things around the globe, basically, that have us stretched militarily without having a direct war. And I don't think we're likely to, but I'm not a war expert or geopolitics either.
There you go. Derek has a question, says, I thought the rule was every 1% increase in rates meant a 10% drop in prices. Why aren't we seeing it? So I'm not aware of that rule. The only rule with 1% that I'm aware of at the moment, and it's not even a rule, it's just something that came up here recently, is that every increase or decrease in 1% either adds 4 million buyers to the market or removes them, right? So if rates go from 7% to 6%, you add essentially 4 million people that could qualify to buy a home. You just add them to the market. Now, are all 4 million going to buy a home? No, but it gives it an opportunity. So competition goes up. Same thing as rates go up, less competition because, you have less demand. Now, with that, why aren't we seeing the drop in price? It comes down to supply and demand, guys. I cannot tell you how many times since 2020 when people were calling for the crash at the beginning of the pandemic and we moved into this hyper crazy market where supply was low and it stayed low. And I said so many times, the market's not going to do anything. It's not going to drop. It's not going to crash until demand exceeds supply in a meaningful way. And we still have not seen it. And we're still there. So that's why you're not seeing a drop in prices in most markets, because there still is an inventory issue that is not going to be fixed in the short term. In fact, I'm one of those people, I don't know that it can ever be fixed, but I don't want to be the Mr. Negative person on the internet saying house prices are going to go up forever, because I don't like that. I don't think that should be the case. It shouldn't be the case. In fact, I think prices should moderate, but I don't see a world where that's going to happen in a meaningful way anytime soon.
Jeb, take away the inventory issue, which is a big issue, and you are 100% correct on that. But let's talk about home prices being sticky to the upside. That is a fact. People do not want to sell their house at a loss, and to them, a loss is anything less than the last sale in their neighborhood. It's not anything less than what I paid for it. It's anything less than the last sale in my neighborhood. So what you are far more likely to see, to Bill McBride's point, in the early 80s, what we saw was a period of very flat prices. So in real terms, once you adjust for inflation, home prices are going down. But in nominal terms, me saying, hey, I can sell my house, people just sit on them. So for us to see what we saw in 2007, 2008, you have to have a large wave of forced sales. Anytime we've seen 7, 8, 10% corrections around the country, let's say double digit, anything 10% or more. You have Houston in the early 80s when their economy got decimated by the oil issues. We have Southern California in the late 80s where we had all of the military base closures and you lose all of those defense jobs. So you have this economic shock. People don't have income. They don't have a choice. Given a choice, if I can tough it out, suck it up, and make my payment, I will sit there and wait till I can get more for my house than the last sale. So there's more to it. And I guess the last thing I want to say about this, Jeb, that this rule doesn't make any sense, because if interest rates go up, it's because of inflation. If we have inflation, inflation applies to homes just like it applies to everything else, absent forced sales, which comes back to supply, demand. So from that perspective, it's a silly rule. Whoever thought that was some sort of magic.
Good point. The comment from a realtor named House earlier, following up, and the reason I bring this up is because I actually want to comment on this. Says, I guess I meant short-term benefit to make political candidates look like they are doing great. So let's just kind of scratch everything and talk about politics for a moment, not in the way that most people think. But I was talking to a buddy of mine this morning who sells luxury real estate. You're talking 5, 10, 20, 30, $40 million homes. And, we often in the gym kind of update each other. Hey, what's happening in your price point? What's happening in mine? Whatever. And he basically said, look, my price point's slow now. Most of the buyers, wealthy buyers, are sitting on the sidelines. They're waiting. And I said, do you think it's political? And he said, absolutely, it's political. That these people want to see who gets into presidency before they make a decision. They believe that one candidate will do better for the market than another, and therefore they wait and see what happens when you're spending that kind of money. Does that apply to the 1.52 million? Maybe to some degree. There's definitely people out there, but less, right? Because their income is less affected by what happens politically. And what I mean by that is a lot of the wealthy people have money in the real estate. They have money in stock market. They have money, in different things that could be directly impacted by a change, with in politics or not in politics per se, but in laws that come to fruition through a change in politics. So with that said, is there a political element to the market this year? For sure there is. But I don't see it in my price point. I don't deal with that, right? My clients aren't saying, Jeb, I'm not buying because of this, but there definitely are people out there. So anyway, I'll move along.
Can we jump ahead, Jeb? I've been triggered.
Yes. Oh, all right.
So Abhishek Sakpal says, you get a rundown old house for $500,000 in Massachusetts. LOL. The greed is insane and real. Why we see versions of this all the time. Sellers are greedy. These greedy sellers. The price of a home is the fair market value of a home, Jeb. What's the definition? It's what a buyer and seller will agree to in an open market with all pertinent facts known. We have that market. We have a multiple listing service. We have agents. We've got all sorts of places you can post this. So a seller can't go, you know what? I am a greedy SOB. I want $60 million for my house. Which one of you idiots is going to give it to me? Because no one will give it to them. There are buyers who are lining up and saying that house that you think is not worth 250, 400, 500, 900, whatever it is in your market, that think that number is insane, that are lining up to do it. There was an article in the Wall Street Journal, Jeb. There was a horrific fixer in San Jose that ended up selling for 750, and it was a teardown. It was a teardown for 750. People are like, that's insane. There were 14 offers. So was the seller greedy, or is the market telling you when 14 people line up and offer you more than the seller is asking for the house, that is what it is worth? You got to put away this idea that someone out there is greedy, because if you own that asset, you're not going to go, hey, you know what? I'm lucky. I bought that for $200,000. It's worth $500 now. These poor people can't afford and can't get in. I'm not greedy. I'm going to let it go for $450. That's stupid. You're going to list it in the MLS. You're going to solicit offers, and you're going to take the highest offer, because that's what sellers do.
Agreed. 100%. 100%. And with that, what I will say is that overpriced homes in this market, in any market, but really the market we're in now, will sit on the market
and get crushed. They'll sell for less if they ever sell.
You cannot be greedy in this market. And in fact, the conversation I was having with the agent that I mentioned a moment ago, he said, that is something I'm telling sellers right now, like blatantly, if you want to overprice your home, it is going to sit. It's simple. We've got to price it where we think it's competitive in order to get traction, especially in that price point where homes aren't getting the traction that they were a couple of months ago. Josh, let's see here. We've got, this Javier posted this question earlier, just says, is it better to buy new or old with this housing market? So to each his own. Some people want new, some people want old. There's definitely pros and cons to each. Typically when I look at new in our market, this doesn't apply to all markets, but new in our market, it means a smaller lot. It means a house that's probably built up versus expansive. Like you're not going to find a single level home that's new construction, not in our area, just because too much land it takes up to do it. You're going to find Mello-Roos, which is an additional property tax on that home. You're going to find it further away from the epicenter, if you will, if you can call Orange County an epicenter, right? It's going to be further out from things than, other locations, typically speaking, unless it's an infill development. Old, obviously, the issues there are obvious. So it preference, right? Now, if you can go buy new for what an old house cost in your market, like some markets out there, like they're selling new construction at what an existing home, parts of Texas, I see stuff like this happening, then it may be worth considering new versus old just because you're getting a newer house. But also understand that new doesn't necessarily mean it's built better. It doesn't mean a lot of things. So just make your own decision, see what you're happy with.
Couple of fun stories here that I think will be enlightening for those of you who are considering this. We talked a couple months back. A good friend of mine went to high school used to vacation with her family. She calls, hey, I just got a big raise. I want to buy a house. Of course, she goes out, finds a new home, and she goes to the builder's lender. They give her $30,000 concessions. And I said, well, let's look at it. It's definitely not $30,000, even if the
I think we
number
talked
on there
about
is
this one
30.
last week.
So we looked at it. It was actually 18, but anyway,
Yep.
you cut it. You got to go that route. And in the real world, if she's looking at an identical house and it's same price that's built 1 year ago, 5 years ago, and she's buying it, she's not getting that. So she's in there with a 0.5% lower interest rate and not paying any closing costs. So it's like, that's the big driver. There are some cons. I'm probably going to have to do some landscaping. I'm going to do window coverings. I'm going to have to do some other things I wouldn't with an existing home, but those concessions are monstrous. But here's the big but. This is a story I really wanted to tell, Jeb. That's not consistent around the country. I have a client in Tennessee right now buying from one of the top 3 major national builders. And she's saying, well, they're forcing me to talk to their builder. We've helped them get their score up 50 points, all those
Their
things.
lender, not their builder.
They're the builder's lender. So these guys were referred by a very VIP client of Jeb and I's that we've done multiple. He's sold multiple homes. I've done multiple loans for them. It's brother and sister-in-law. We've done great things for them. So they're saying, you got to use our lender. I'm like, oh shit, here we go again. They're going to get an offer they can't refuse. And she goes, okay, well, they can get us in for like 5,000 less than you, but that price is going to go up to 416. I'm like, I don't understand. What are you even talking about? The price is $399.9. So it's $400,000 house, same 416. So I look at it and they're saying, if you increase the price to 416, we'll give you $16,000. They're not giving you anything, but they're saying we'll only do that if you use our lender. I'm like, that's crazy. They're offering you the chance to have an expensive loan with lower closing costs by raising the price. And that's it. They've been holding on, and she's held her ground. And she's like, I'm not. They finally came back, to their credit or not. They came back and matched our terms, but just matched them. She goes, if you're matching them, I'm going to use the person that got me here. But we talk on the show, Jeb, that it varies where you are in the country, how much the sellers have to do this. The builders have to do this to move homes. If they don't have to move homes, they're not doing that for you. So parts of the country, they're going to make you an offer you can't refuse. Other parts of the country, they're going to dick you around because they have so many people coming in to buy these homes that they feel like they can.
Absolutely. So a couple of other good questions here, Josh. This one's quick. I'm just going to click on it just to get it off our queue here. Susie asked, are we ever going to see 4% interest rates again? Yes, we will. When? Don't know, but you'll see them again for sure.
I wouldn't wait for them. Do what's right.
No. But it is in the cards. I mean, it's happened before. Prior to the pandemic, it will happen again. Let's see, Josh.
Well, Jeb, let's bits of interest is just firing tons of questions at us. So let's just knock them all out. Okay. So easy one, because this will apply to everyone. Are the 2 months prepaids included in the reserves estimate I got from my local bank? I can ask the loan officer, but you're the one streaming. So prepaids, that's the amount required to establish your impound account when you close. So there's also prepaid interest. Let's say you close on the 15th of the month. On the 1st of the next month, you're not going to make a payment. The builder or the lender does not want 15 days of interest. They don't want a partial payment. So they collect that interest because they're going to make the loan to you on the 15th. They collect it at closing. And then the following month, you make the first payment when 30 days of interest have accrued your first full payment. But you also pay your first year homeowner's insurance premium. And then the 2 months that he's talking here, they collect 2 extra months. Remember, the first month, you're not going to make a payment. And they have an extra month because they can get a cushion in there. So they actually have that 1 extra month. And then depending on where you are around the country, they're going to have to collect some taxes at closing. And that depends on what your taxes are, what this payment schedule is. Many parts of the country, they're only paid once a year. Some parts of the country, they're paid twice a year. So those prepaids are going to vary considerably depending on where you're at. But most important one, bits of interest follows back. It says, just found you guys this week. Wish I did before I got serious. View bid, inspection, etc. And then follows up, he's in Texas. If you want us to just do a second opinion on this, I'm happy to look. Local banks generally don't have the best terms, whether they can explain this stuff to you and get it for you or not. But if bits of interest, if you or any of you out there, you have numbers, we talk about this all the time. I'm happy to take a look at those and tell you whether we can do better than that, whether it's awesome. And occasionally, like the reality is once you've started and you've done an application with someone, you don't want to go down that road again. You're not going to do it to save $500. It's going to have to be a significant difference. And I don't know, would you say, Jeb, it's maybe like 50-50? Half the time you look at it and you go, that's terrible, we can save you a bunch of money. And half the time, like, no, they're doing a good job for you. If you like the person and they're communicating well, continue down that path. But in this instance, bits of interest, you're in Texas. If you want us to do a second opinion, we can show you what we could do to match there and answer any of these questions for you.
In fact, if you want to get in touch with Josh in any of the 18 states that we're approved in, that referral link at the bottom will get you in touch with them. If you're looking to buy here in Orange County, I can personally help you. And anywhere in the nation, I can refer you to somebody that I know, like, and trust. In fact, a lot of you have reached out, and I've helped a lot of you connect with real estate agents. So that's
very good real estate agents.
It's been a win for everyone. Love for puppies. Does the amount of equity you have in the home affect your rate when you refinance? Yes, it does, up to a certain degree. I think once you probably have more than probably 30% equity, Josh, you can tell me the actual number.
Well, let's look at the times that it doesn't, Jeb. FHA, VA, USDA, the rate is what it is. They don't care about loan value. But Fannie Mae, jumbo portfolio lenders, most of them absolutely do. The more equity you have to a certain point, you're going to get better terms. And with Fannie and Freddie now, I want to say for anyone with a credit score above 640, that level is 60%. So 60% loan to value, 40% equity in the home. But if you look at the lower levels, that LLPA matrix, Jeb, goes all the way down to like 30 or 35% LTV if you have really, really bad credit. But for anyone with a decent score, it's 60% below is going to get you the absolute best terms.
All right, guys, going to hit another question here. But if you haven't done so already, you find any value at all, do us a favor, hit that thumbs up. Josh, we got a couple new names here that I'm going to click on to help answer some questions. Matt says, how long do you think we'll keep treading like this until we see our first drop in rates? What's a drop? If you're talking Fed funds rate drop, that could happen as early as September, I think. If not, it's probably going to be December. So September or December is probably the likelihood of a drop in the Fed funds. A drop in the interest rates, I don't think you're going to see a drop. I think you see a gradual decline, just this little trend lower on rates, probably for the foreseeable future. But we talk a little bit about that more. Actually, we talk a lot about it in the forecast that we recorded that's going to be published next Tuesday on the Educated Homebuyer podcast.
Yep.
Josh, this is a softball for you here. What is the minimum percent drop on an interest to refinance on a IRRRL, a VA interest rate reduction loan?
You say the fun part, and I can't say with certainty on this. So on an FHA, you have to save 0.5% between interest rate and mortgage insurance. So the mortgage insurance, you say, it's just flat for everyone, but it's changed over time. So a lot of people out there have a really low rate, but with a 0.85 mortgage insurance. So between rate and
we're talking VA here, not FHA.
Absolutely. Understand that. So we got two different things here. The bigger concern with VA is they're looking at your recoupment period. Whatever that loan costs, you have to have monthly savings that will cover the costs of that loan over 3 years. I do believe they have 0.5% also, but for me, you're more likely to get hung up on the recoupment than you are, but I believe it's 0.5% also. But if I'm wrong, and there's a loan officer in the audience that knows this for a fact, I'm just having a little brain fade right now. I'm 90% sure it is 0.5%.
Josh is off his game tonight, but that's okay because
it's been that way for a couple weeks.
He's always on his game, so it will allow it once. Big G has a comment that I want to read because it's something that I think has gotten in the way, kind of one of my biases, if you will. Big G says, I've read that as a nation, we are now spending more on interest on our own debt than we do on our defense budget. That is an accurate statement. And we're close to spending more than we do on Social Security here real soon. So when Josh and I, over the last couple of years, have talked about the Fed can't continue to raise the Fed funds rate. They can't continue to do this. Why? Why can't they continue? Because they're paying more money to service their own debt than they have the money to do already, right? We're already 34 trillion or so in national deficit, and just adding to it by continually adding interest on that debt. So you look at that and go, how far can we go before somebody has to say, uncle, right? Cry uncle. We can't do this anymore. Something has to change. I thought we probably would have been there by now just because of all the craziness with the economy and everything else. We clearly aren't there, but it's a problem. That is, you think we have a problem with housing? We do. We have a real problem when it comes to the national deficit, an unsolvable problem. It's unsolvable unless somebody just cleans the slate and starts over, which could it happen?
Which some people
Sure.
are proposing, right? There's people talking about this both
But
globally.
it only
and
works
Great
if people,
Reset.
you got to stop spending though. You can't just swipe it clean and say everything continues as normal, because that's the
back
thing.
to normal.
That's like people doing a cash out refinance, paying off their debt, and then their spending doesn't change. It's the same exact thing, but on a bigger, much bigger scale. So anyway, I digress. We move on. Josh, qualified buyers. What do your qualified buyers look like? Well, let's say this. Don't even go qualified. Out of the calls that you receive, how many people out of 10, how many people actually qualify for a loan, and how many don't? And what does that look like when they do?
So I'm going to have to throw another qualifier in there for you. I'm going to say about 60 to 70% qualify. How many of them qualify for a loan to buy something that they would be willing to live in? So if their market is 400, do they qualify for 300? Do they qualify for 400? If their market's $1 million, do they qualify for $1 million? They qualify for 700. So I'm going to say probably about 50% qualify for what they would be willing to buy.
Okay, that's fair. And of those 50%, what are we talking about credit score wise? Just a number, just an average. And down payment wise, are they coming in with 20% down, 50% down? Or are these buyers with low to little down?
And let's remember this. We've talked about our buddy Mike down the way, our friend Al. These guys are doing they're in the same market as us, but they're doing higher end purchases, and they have a very different clientele. For me, I do primarily deal with folks just like you, first time buyers. And from that perspective, we get some of them, they're doing 10, 15, maybe even 20% down, but we're not getting these monster down payments. So I'm going to say it's probably pretty similar to the national numbers that we see when ICE or Black Knight or whatever they call themselves now does their mortgage monitor. They're saying that it's close to 7 or 8% on average, and that's about right. And it's probably split evenly between minimum down, 3%, 3.5% FHA, 0 VA. And then you've got people doing 10%, would probably be more common than a 15 or a 20, but some of those do come. Now, I will say conventional borrowers, those are high 700s, 740 plus, most of them 780 plus. That first time buyer, FHA, very rare that we have anyone under 640. The reality is it's hard to qualify, and there are very few people that have a 620 credit score or say a 600 credit score that have the money, that have the debt to income ratio, that will qualify for a manual underwrite, and then are willing to put their chips push their chips into the middle of the table and actually buy a house. Some of them we can get them approved, but when the rubber hits the road, they're like, this probably isn't prudent. I should work on getting my credit higher. So I would say 640 to 680 for FHA. Most of my VA buyers are in that 660 to 750 range, and conventional buyers are for the most part 740 and above.
All right, good stuff. Jonathan, how many weeks is reasonable for a seller builder to address a punch list items after closing? I can't answer that question directly, but my recommendation is if you're buying new construction, have the builder do this prior to closing. Have them address anything that needs to be done before you close on that loan. Otherwise, you're waiting on them. You're in the situation where, depending on what it is that needs to be done, it might affect your living situation to some degree. So do a home inspection, even though it's new construction. Spend the money, guys. It's $400 or $500, depending on the size of the house, clearly. But spend the money, have an inspector go through it, punch list it, and tell the builder you want it done before you're closing. Simple. They need you as much as you need them in most cases. So they don't want to walk away from it, especially when your financing is there. They'll do the list. But sorry, Jonathan, I can't speak to that, but I would just continue to put the pressure on them. Call them daily, email them, make sure they do it. That's the best way to get anything done, unfortunately. David says, don't you almost have to price it pretty close to right, or you risk it not even appraising for your asking price anyways when talking about the price of a home? Yes, to some degree, right? I mean, you need to price it at fair market value, but here's the thing. Not no one. Most people aren't completely overpaying for homes at the moment where appraisals are an issue to begin with. And when you have, a seller willing to pay a price for a home, I would say 9 times out of 10 it appraises for the most part. Rarely ever. I haven't had a property, knock on wood, not appraise in a very long time. But that's part of me knowing how to price a home when I'm on the selling side and how to comp a home when we're on the buying side. So just make sure you have that. Steve Josh says, do you have a recommendation for a portfolio lender? What I would say is use that referral link, Steve, on the bottom there. Get in touch with Josh, our team here, and Josh can get you in touch with a portfolio lender, or he can do portfolio loans. So, depending on if it's one of the states we are licensed.
One of the states we're in, and like people say, well, I want a portfolio lender. And the answer is, or the question is why? Why? Because they're not all the same and they all have different niches. So it's not just a portfolio lender. You want the right portfolio lender.
Agreed. Christina's got a couple questions here we're going to address. Is this considered a buyer's market or sellers? I would say in most states it's still a seller's market. Some markets out there, it looks to be a buyer's market. There are parts of Florida, parts of Texas, parts of Louisiana that have a buyer's market feel to them, where it's a little bit more balanced than it is anything else. But I would, depending on where you're located, it might be different than that. You also follow up and say, any tips on selling my house fast? I'm currently living here with family. Price it right. Simple. Send me the link. Email me the link. I'll give you a friendly opinion of what I think. I can't tell you price-wise, but I can tell you photos. I can tell you things like that. Most people skip on some of the things that can help their house sell, and ultimately affects, how fast, the price, all of that stuff. So I'm happy to look at it and tell you if I see anything, but I can't really give you advice because you're under contract with another agent. But it comes down to price. Pricing it correctly will help it sell fast. Josh, we got a couple variations of this question. So we're gonna hit it here. This one's from Parmad, but it says, after home purchase, how long should we wait before we start shopping for a refinance rate if we're not happy with the current lender? Any legal restrictions? So there's a couple variations of that. How soon after can I refinance? So on and so forth. So what does the time frame look like after you close?
You can generally refinance immediately because you 99.9% chance do not have a prepayment penalty on your loan. There's no legal ramification. So it's really just, do you have a prepayment penalty or anything else preventing you from doing it? And then is there enough of a benefit to do it that the new lender could meet the net tangible benefit requirements to justify doing that loan for you? Those are the big ones. The thing to be aware of, it sounds like you don't like your current lender, so you may not care, but we've gone over this on the show before. If that loan pays off within the first 180 days, the lender that did your loan has to pay back everything they made on that. So essentially they worked for free in doing your loan. So if they've made you mad and you don't care, go right ahead. Otherwise, at least talk to them. If rates have moved enough that there's a benefit where you want and need to do a refinance, at least give them the opportunity to earn your business and make some money on the refinance to cover the loss they're going to take on that other loan. It's pretty rare that a loan pays off in the first 180 days, but it does happen.
All right, good stuff. David says, do I have my own real estate team? By team, no, I'm pretty much an individual agent with a buyer's agent. So if you hire me, more or less get me, or my buyer's agent, Courtney. Outside of that, I don't do a team. I don't want to do a team. I don't want to manage a bunch of different agents. That's not, I like where I am, and life's good. So if I can help, reach out. That referral link will get you to me. Josh, there was another one here that was good. What do you think of Rocket Mortgage, Josh?
They're trying to trigger me. If you want,
no, let's go this. I'll make it really easy. Really easy. On a scale of 1 to 10, how would you rate their rates? Well, let's start there. How would you rate? Well, I'm going to do rates last. How would you rate their customer service, having a professional on the other side, 1 to 10?
Customer service, they're going to be nice and friendly to you if you call.
No.
So that's probably
having a professional, a knowledgeable expert on the other side of the phone.
No, you're going to get a kid 5 or 6.
That's higher than I thought.
They're going to give them training. I mean, some places, if you just call a random call center in your neighborhood, they might have hired some idiot yesterday and just thrown them in there. At least Rocket's going to put them in a 6-week class before they let them take calls.
All right. So timeliness. How about getting things done on time?
It will be an interesting process. So let's call it 6 or 7, something like that.
6 or 7. So we're peaking at 7 so far. We'll make this short. I don't want to get us in trouble. Rates. How are they on rates? How can they be on rates? Depends on the loan, right?
Below 5. And with that, they're never going to obliterate you, but they are never going to be an affordable option for you. Generally, if someone calls me and says, hey, we need to close in 2 weeks, I'm dealing with Rocket, could you do a better deal? I can tell them in no uncertain terms every time, yes. Best example, listener to the show reached out one weekend about 3 months ago. He'd been working with Rocket. He was happy with all of the things Jeb just asked about, like the person he was dealing with. Process was going fine. They had him fully pre-approved. They gave him an underwritten pre-approval letter. He gets his offer accepted, and then they send over numbers that was the same interest rate we were going to do, but him paying almost 2 points to get it. And he asked him about it, and they're going, sorry, that's just the rate. So they do a very good job of not letting you know what you're going to pay, but doing all these wonderful things, giving you the whole smoke and mirror, dog and pony show. And then when it comes down to it, the terms are never going to be good. So I don't care. There's nothing else that you could tell me about what they do that would make it worth dealing with their terms when a local broker can get you significantly better terms 8 days a week.
All right. Good stuff. Bits of Interest has another question here. It says inspection 1962 house brought up a bunch of stuff. Electric panel isn't right. Some plumbing doesn't work. Can we negotiate this as a credit towards closing? We need cash to fix it. So what I would say is talk to your agent. But I'll give you an example. I have a clients rather, who are buying a property here in Huntington Beach, and this is a condo, and we were under contract at a price of $610,000. There were quite a few things in the property that needed to be addressed. There was some electrical stuff, some plumbing stuff, some all around stuff that needed to be fixed. We negotiated a price of $602,000. So $8,000 off the price. We didn't ask for a credit to fix it. We just asked for a change in price, because the change in price, they have some money on the side that they can do the stuff, but the change in price gives them a lower mortgage because they're going to keep the down payment the same. And it's going to have a lower tax basis, not by a lot, but it all adds up. So we tried to negotiate that. So I would say, based on what you're asking there, very reasonable for someone to renegotiate a credit, renegotiate a price, but also understand what you're in. If you were multiple offers going into it and there was a lot of competition and you had to do crazy things to get it, there's a little bit of leverage on the seller side. If you're the only offer, it's been on the market for a little bit, things came up, a little less leverage on the side. You probably have the leverage and these are, but when you start talking about electrical, these are things that probably most people are going to want to get fixed. So I think it's very reasonable for someone to ask for that. When I sold my house recently, the guy wanted a new electrical panel. I'm like, sure. Okay. Like, fine. And paid for the panel. Like, I'm not going to sit here and harp over, a couple $1,000 that, if they don't move forward, I got to go back to the market and redo. You'd lose more money by doing that. So people have to think of it like that. All right, Josh, we're here just over an hour. If you've still here, do us a favor, hit the thumbs up. If there's any value that you've taken in this evening, if you find any value in Josh and I's show. If you're not aware, we actually have a podcast too. The Educated Homebuyer has its own YouTube channel. It's on Spotify. It's on Apple. It's completely different than this show, by the way. This is live Q&A. That is us educating you on the housing market, on different elements of it. If you're new to home buying, new to the product, go check that out. Really, a lot of value there, and it's free. It's free information. It is a school of education for those looking to buy a home. So, Josh, where are we?
Our friend Mina is here. What we do? She's got a question for us. Do you have to recast with the same lender you had the first mortgage with, or can you use another lender? No, if you're going to do a recast, it is absolutely with your current lender. Yep. It is a modification of the terms on your current loan. So everything else stays the same.
Because most people don't understand what a recast is.
So I have a client right now that's actually doing a refinance because they can actually benefit from when they bought one, about 6 months ago when rates were higher. A listener to the show in North Carolina, Jeb's homeland, and they were looking at doing a recast. So in their instance, they bought their current house, then they sold the other one. Now they've got $250,000 in their pocket and they want a lower mortgage payment. So they had the option of calling up the current lender, saying we're going to make a $250,000 prepayment, or principal reduction. And then what we want is for our monthly payment to be adjusted so that if I've got 355 remaining months on my loan and I have a new loan amount, my interest rate is not changing. What is the monthly payment that will pay it off over those remaining 355 months? Otherwise, if you pay the big principal reduction, $250,000, you still have the same fixed payment because it's a fixed rate mortgage. You're going to pay it off way early because you're going to have much less interest than that amortization schedule shows for it. But it is absolutely with your current lender. It's just a modification of the current agreement.
All right. And Mina, as she always does, comes with the $5 super chat. So
that's why Mina always gets her questions answered quickly. Yeah. That's how you
if all of you guys give us $5 right now, we'd have $850. Yeah. So I don't know why you're not doing it.
What are you waiting on?
Use that, people. No, in all seriousness, not necessary. But Josh, let's do one more here to finalize the show. Happy Juneteenth, people. All right, because you probably want to continue celebrating. I know a lot of you had the day off, and you've probably been at the bars. You were probably out day drinking, having a great time, and you stopped to come and watch the show. And we appreciate that, but we don't want to tie you up. We want you to get back to the party. And therefore we're going to keep this accepted.
Jeb, we got a great question.
That made absolutely no sense. I was reading something as I said that. We're going to make this short is what we're going to do. Go ahead.
We got a great question. Coley pops up here. I'm getting ready to refinance a VA IRRRL. I'm getting tons of offers from banks advertising 5.5% to 6% mortgage rates. I don't see the points in these quotes. Are these quotes legit? Are they legit in the fact that you can get that interest rate? Yes. Are they legit that you're not paying points? No. Whatever you do, use any lender in the world, even if it's Rocket, but do not call any of the monkeys that are sending postcards into your mailbox. You are going right into the teeth of the beast of these call centers that hire kids that know nothing, because a VA IRRRL is about as simple a loan as you can get. And they go, you need to know these 3 things. Get the borrower to send that in, kill them all, let God sort them out. We'll figure it out on the back end. So please do not call anyone that's sending you a mailer. Call us, use the link below, call someone, get a reference, go back to the person that did your original loan, but do not answer a mailer showing up in your mailbox.
There you go. All right, guys. So that's it this evening. We appreciate you being here. We appreciate the support. We can be of any value to you at all. If you need to get a mortgage, you need another quote, you're looking to buy a home, need a real estate agent, we are here to help you. That referral link at the bottom there will get you to us. And if there's something you want us to talk about, let us know in the comments. In fact, let us know in the comments what you thought of the show. Josh, any parting words this evening before we head out?
No, Josh is brain fog, is coming off 10 days of high stress levels and low sleep, thanks to a couple of interesting loans. So hopefully I will get some rest between now and next week and be a little better for you guys.
And Coley came in with the $10 super chat. So thanks there, Coley. We appreciate you. And until next week, guys, adios.
Amigos.